Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is Hugh Hendry, the notorious macro hedge fund manager who's now giving macro bits, laying down the understanding of the landscape. Hugh, welcome back.
What a pleasure to be back. And this time I've swapped the salty, sweaty atmosphere of the Caribbean and I'm high. I'm really, really high
Yeah.
up in the mountains of Utah, just up from Park City.
Well, it's an absolute pleasure having you back, Hugh. And, we have a huge topic to talk about today. The death of the US dollar is what everyone is talking about. And China and Russia are now buying records amount of gold while dropping the US dollar. Is any of this a threat to the US dollar or just smoke and mirrors?
It is categorically not a threat to the US dollar. I tweeted the other day, I said, you can be summed up in one word, but I'm not good with numbers because the one word was bullshit. And I think that's two words.
Why is that?
So,
Why do you think so?
um, hey, listen, we are here in this world where the stock market to GDP in the United States and of course elsewhere has gone from 50% of the economy to 2x the economy, and it's come with the rise in international trade and a renegotiation of how continents settle their trade differences. I want to tell you that after or the in the aftermath of the Asian tiger crisis at the end
Hmm.
of the 1990s, um, it set a precedent in terms of the vicissitudes of trade flows, of having very open and liberal capital accounts, where the George Soros's, poor George gets such, we're on this channel not to spread prejudice. We invest without prejudice. Leave old George alone. But the notion that masters of the universe could determine the fates of countries, and more than that, could determine the fates of the political leaders. China watched that very carefully, and we've renegotiated the international trade contract. And by that, what I want to say is that China has been operating with a closed capital account.
Hmm.
And the significance of that is all of the trade flow into China in terms of, they have run persistent trade surpluses for more than 30 years. So all the dollar flow that comes with that, and then if you add on top of that investment flow and speculative flow, which would be very much the small cousin of the rest, all of that, if you will, like a snowball, has been gathered by the Chinese Communist Party and is being thrown right back at you in terms of what we see an extraordinary, we live in extraordinary economic times where all of the world's capital surplus is channeled and reinvested back in to America. The world's busted because all of that surplus saving is meant to go and seek higher returns in deficit nations that actually cannot finance the domestic investment program with domestic savings. That's clearly not the case in the United States. Domestic investment needs are more than adequately covered by the domestic savings. And
Mm.
so what we're doing is we're like taking Mount Everest and we're dropping it into, I don't know, Lake Geneva. There's a lot of hedge funds around Lake Geneva. And the tsunami of that, this liquidity, is what has pushed us into this Frankenstein world of fictional wealth and 2x stock market cap to GDP. The understanding comes principally from trade.
So, Hugh, can the US government and the Fed continue on their current path with all this massive deficits and all this massive debt without ever trashing the credibility of the dollar? What's your thoughts?
Um, yes, it can, with one caveat that the cost of carry, the Fed funds rate, has to be set at zero, or we have to have negative real rates. Yeah. On that basis, we can persist. We're presently climbing the steps of a very high cliff, and we're going to dive over the cliff into another episode of great economic catastrophe because, of course, the Fed has taken rates from 0 to 5% back in the late 70s. The former chancellor of West Germany so long ago, we have to refer to West Germany. But when the Fed was at 20% rates, Fed funds, he said, rates are at the highest level since Jesus Christ walked on earth. Okay. Well, you know what? We're back at the highest level of interest rates ever. And you say,
Wow.
well, hold on a second. How does asset capitalism count? Because we're at kind of 5, not 20. But of course, the difference being the debt multiplier, the debt to GDP is 4x. And back then it was 1. So 4 times 5, you're at 20. And so it's comparable. And we're at levels where you break things. So the breakage and indeed the persistency of the dollar will not be determined by China or the little Soviet guys who, remember, just 2% of global GDP. China's kind of real, it's 15% of GDP, and of course much greater in terms of trade flows and all the rest. It won't be determined by them and their little games with Lulu in Brazil and his suntan, and they're transacting in renminbi. That oil trade.
Mm-hmm.
Think of it. So, because what they don't represent to you is the amount of daily volume in oil futures is 90. It is a minimum of 90x, 90x,
Mm-hmm.
the actual daily trade between, China and Russia and Saudi and China, etc. Right? So that it's a great headline, but in reality, it's nothing. But again, I do believe the system of international trade, which is so horribly disconfigured, will end. But it will end when someone with enlightenment, I mean, this is a big ask, but when a policy advisor finds a charismatic political leader to speak to the American population at large and say, this is not a privilege, this is an exorbitant burden on the household sector. Yeah, we
Right.
are being hollowed out by a system of economics which is pursuing disequilibrium at the expense of the United States household. And the solution is there, just has to be grasped. The solution for the United States is to put it back to the Chinese and say, you know what? We're going to remove this unfettered access to sovereign capital flows into our capital markets. We've come to recognize that its principal aim is to keep foreign exchange levels such as the renminbi, where you require 7 renminbi to buy a US dollar,
Mm-hmm.
when economics would have it trading at half that level. You should be able to buy US dollars for like 3 or 4 renminbi. Okay,
Right.
that has happened because they've hoovered up treasuries. So the US should be replicating the Chinese strategy. Okay, now the implications of that are financial assets will shrink versus the real economy. We're at the peak. Yeah, we're at the high. And either we're going to get there and we're going to propose and we're going to modify the system, or there's going to be a revolution.
So, Hugh, you're proposing that we follow the path of Japan, basically to 0% rates and have never-ending deficits. If that's the case, will there be a huge rally in gold? Do you agree?
I am not proposing anything of the sort. I am telling you that is being imposed upon us by the prevailing status quo, right? We have a system which believes in idolatry. We have to worship things, okay? The present altar of worship has been everything Chinese, and that's why they get away with the nonsense of these headlines that they're going to bring down the dollar. China cannot become or supplant the US as a reserve currency because it doesn't have an open capital account. It is calculating every single day the appropriate exchange rate that makes them competitive, which allows them to run a current account surplus, a trade surplus rather, with the rest of the world, which is at unprecedented levels. It's 1.5% of global GDP. And it's getting to levels where it's very, very provocative and it's making people angry. And so, if you will, they're putting out, it's like Top Gun, and they're firing out these kind of this spray and stuff to kind of camouflage the danger in the system is the mercantilist model, which is it is refusing to allow the system to clear. Now, don't get me wrong, they are pursuing the same path as America pursued in the 1920s. America did not have its manufacturing sector destroyed by the First World War. And yet, when the gold standard was reinstated, it was left undervalued. And with the surging, and I stress surging productivity from technology from as far and wide as chemicals to telecommunication, the US was a beast. It ran profoundly large trade surpluses with the rest of the world. Now, economics is designed to restore equilibrium. And America, and principally the New York Fed, cheated. Okay. How did they cheat? Because the reciprocal of the trade surplus is that back then you would receive gold bullion from other sovereign nations. And that gold bullion was high-powered money. It was to be placed in the vaults of the private banking sector in America. Now, that would represent a liability to the private banking universe. And with that liability, they would be encouraged to create assets. What are assets?
Right.
Assets are credit, they're loans. And so you would be fueling more credit expansion into what was already a very, very powerful economy. And so the Fed desisted, okay? And it sterilized the gold flows. They never reached their intended target. America should have boomed and then, if you will, gone bust well before the denouement of 1930. That's how it's designed. So the gold was meant to power incredible economic growth, which would then come back to the rest of the world in terms of demand for the rest of the world's goods and services. But the sterilization prevented it. And so it went into financial assets. We created profound levels of fictitious wealth, and the system went boom. Okay. That is where we are today. Rather than gold being this reciprocal flow governing the behavior of sovereign nations, it is capital flows and the unfettered access into American markets. And with the Chinese being fettered, being restrictive on what they allow in, is exactly the same flaw as the New York Fed in 1927 and 1928. And we are left now at a very, very vulnerable point where asset classes are going to come down. And it would seem they're going to come down in the first instance, owing to the Fed, a Fed that always sees inflation and doesn't recognize the vulnerabilities to the system, and asset prices are going to shrink. So you ask me, gold in terms of today's gold and the price of gold today and its relative performance to other asset classes, it looks impeccable in terms of a long. My only concern is that I lived through the episode of 2008, and I saw the wise people who could see the crash of 2008, and they sought shelter in gold. And you can't seek shelter in risk assets. So I've actually sold all of my gold, and it's probably
No, you haven't.
You've got to be flexible. You've got to be a macroplasticine trader. And I've done so because my bet is, if I'm right and the severity of the economic slowdown is what I imagine, I think gold, like any other risk asset, including crypto, will be sold. But at that point, I will have the liquidity to buy it.
So Hugh, where are you parking your money in this wild and crazy world we find ourselves in?
Well, in this world, I'm parking my reputation rather than my money. My money's invested in, God help me, in high-end real estate in St. Bart's. Now, I think I've got justifiable cause to think I'll survive. I mean, it was predicated as a macro trade, bit like Bitcoin, in that we have a halving phenomenon, which is that they have the footprint of potential competitive real estate development by very restrictive bylaws on what you can build. We will see. And secondly, there is no leverage. There are only 3 banks in the world that will use the collateral of St. Bart's land to extend credit. So that's a kind of good thing.
Mm-hmm.
But I put out on the 2nd of March, I just pinned it on my Twitter profile at Hendry_Hugh today. And I tried to conceive of a DIY portfolio, for the folks maybe watching this. And what I conceived of was having 55% of my NAV, of my funds. Yeah, I've got $1 million. I wish. And so 550,000 are in the TLT. What the TLT is 20-year plus duration. It's the long end of the bond market. There are others. You can extend that a little bit with more liquidity, but with less liquidity. But the TLT is nice and liquid. So 55%. I had 20% in a basket of commodity equities. Choose an index. I would like a sprinkling of uranium and gold in that portfolio, but all of the uranium equities just look really sexy. I would have 5% in gold because at 5 I could underwrite them being kind of wickedly sold if my worst procrastinations come correct. And then contentiously, I haven't done the maths. Where are we with this? But I think I had 20% in the Grayscale trust and probably favoring the Ethereum class. And there I'm a profound believer in mean reversion. So my biggest asset class is the TLT, and that's had profound mean reversion. Yeah, it's trading at the same price level as 2007. And for me, it's deja vu. I'm like, you cannot be serious. So again, reputationally, in a world where everyone wants to talk about inflation, I'm really long end of the government market. So like, if I'm wrong, you can pee on my reputation. But the Ethereum has, Ethereum et al. Fell more than 80% from the peaks of 2021. And then you buy into the funky and disgraceful nature of what's going on with the Grayscale Trust. It's trading at a 40%, or was trading at the wides, a 40% discount to NAV. So I've got mean reversion, plus I've got a profound discount to NAV. I'll smoke that one every single day. And then I would then use whatever capital was available to underwrite a futures position where I'd be long the dollar and short the Chinese yuan. And then this morning, up here in the mountains with my buddy, we won't goose it more. I think this market's easy.
Really?
It's treasuries, it's no equity. So let me give you a profit profile, which I think is better than equities, because equities, everyone can smell it. I'm pointing at my nose. We can smell the capitulation from the Federal Reserve. Yeah. This is, I think it feels actually like March 1989, and the Fed is at 9.5%. And guess what? The Fed can see inflation. It can always see inflation. But in the intervening years, Michael Milken and his buddies had spread liberally around the financial sphere this thing called junk bonds, high yield bonds. They were in banks, they were in pension funds, and it was kind of fine until the Fed started raising interest rates. Yeah,
that's right.
And then the Fed started to go, Holy Mother Mary of God, what have we done? Yeah. And do you know what it had done?
What?
It had bankrupted the savings and loan industry, who owned a ton of high yield securities. And so the Fed cut. Within 2.5 years, we've gone from 9.5 to 2.5%. I think that's where we are today. This regional bank thing, let me tell you the story of the fallacy of composition. Things that work, things that make sense for you and I, when it's replicated by our peer group, we create pandemonium. So individual banks today are tightening credit. They are very worried about the constraints on their balance sheet and future constraints. That makes a lot of sense for one bank. But when the system does that, what you're going to, because the lesson from 89 was it didn't matter how much the Fed cut rates because you had infected the risk-seeking behavior of the financial community. This
Wow.
old adage, we haven't heard it for a while, pushing on a string. And I think that's where we're going to be. So for me this morning, we were out buying really, really simple, really simple. We were buying call options, 1-year calls on the TLT, and we were buying them at 100. So the strike's 100. They're trading. The spot price is 107. So we're buying it in the money. Okay. And the option premium was $12.6. So there's $7 of in the money, and then the options cost about $5, $5.50. Okay. If I'm right, and this is why the stock market wants to push higher, because the Fed's going to cut, and that's going to be incredible. And what the market's missing is, on average, I read a statistic, I can't attribute it, but on average, the S&P has fallen 26% from the Fed's first cut in interest rates, because these goons cut interest rates because they've broken the system, right?
Right.
So I'm thinking if we get anywhere close to that this year, the TLT is going to trade 150. I'm going to make 4 times my money, and I ain't going to make it in the S&P.
And you're going to put it into gold after.
Yeah.
Yeah,
sure.
Perfect. Well, thank you so much, Hugh, for coming down to Wall Street Silver. That was an absolute pleasure. Everything you said, it was really cool. So thank you so much for coming down to Wall Street Silver.
You guys are the best. Thank you.